Hey guys, it's me, Zeus, and today's video I'm going to break down two trades that I took this week. I'm going to break down a market maker sell model trade that I took on the S&P this week, and I'm going to break down a market maker buy model trade that I took on EU this week. So let's dive into it. So here is the daily chart of the S&P. We have clearly seen a market maker sell model unfold here. We can clearly see that the buy side of the curve has been delivered and now the sell side of the curve is being delivered. Premium arrays are being respected, so we know that the institutional order flow is bearish. I marked out my POI, my high time frame POI, which was this daily fair value gap and the previous day high. I was looking for price to trade into this fair value gap during a kill zone, and I wanted to see if an entry pattern would form for me, and these lows of June were my targets. Here we are on the 15-minute chart of Tuesday's trading. We can clearly see that the market maker sell model is here. We can see our original consolidation down here, trendline liquidity. Retail looks at this as support. We look at this as, oh, this is the next draw on liquidity. Price trades into the daily fair value gap and takes out the previous day high during the New York session. So to me, that signals, okay, there's something going on here. Let's look for an entry. Price traded above the midnight opening price here, above the New York opening price. So this was a Judas swing. Why? Well, retail looks at this as a breakout. You see all these highs here? Buy side liquidity rests above that. Manipulation, distribution. That's what I love to see. If we dive into the lower time frames, this is the 2-minute chart, we can see that an original consolidation was down here, a lot of trendline liquidity. The market trades into this daily fair value gap and takes out the previous day high, and then it sells off aggressively. So to me, that signals, okay, the algorithm is in a rush to take out the next sell side liquidity objectives. So I took an entry when the market showed the willingness to move lower. And we can see that this fair value gap here got respected, got rebalanced. And then I saw a balanced price range get created. Okay. I'm not going to talk about what it is, but I can say that this was a BPR here. So the market trades down, comes back to this old low, respects it, and sells off. And then my first take profit target was hit, my first partial. I didn't want to short this above here yet. I wanted to play the next opportunity. Why? Well, if you think about the concept that I laid out publicly through my YouTube videos with regards to market structure shifts, you know that intermediate term highs, or highs that rebalance a fair value gap, should not be broken through if the market is in a rush to move in the expected direction. So in this case, this fair value gap got respected, got rebalanced by this high. So to me, that is an opportunity to place my stop loss above this high, because if we're going to see bearish delivery, this high should not be broken through. The market expands lower, it retraces, and it continues to go lower, taking out the London lunch sell side, which was my first partial. Then I placed my stop above this high. Why? Well, this high rebalanced this fair value gap here. So to me that signals, okay, the market should not break this high if we're going to see bearish delivery. Are you starting to see the logic that I'm pointing at? So the market retraces into this rejection block up here. This wick is the rejection block, takes out this buy side liquidity here, but it does not break this high. Did I get scared when the market did this? No, because I already took most of my position off at a 1.1 to 3R risk to reward. So my stop was already close to break even. So I didn't care if the market was in a rush to take out the June lows or if it wanted to continue higher, because I already got paid. And that's why you take partials. If you keep on holding your position the whole way for that final daily target, for that whole daily range, do you think that you will be able to sit this whole retracement out? Imagine that you're in profit here with, let's say, 10k. You're 10k in profit on your demo account. And you see the market retrace to your entry point, and you see that 10k just move away, just disappear. Do you think you would be able to sit that through? No, hell no. But if you would have taken 7k off here, 70% of your position has been closed here, and you wait and you trail your stop loss to a logical place, and then you see the market retrace, do you get scared? No, hell no. You need to wait, you need to be patient, and you need to have the wisdom to just accept the fact that if the market takes you out or hits your trailed stop loss, that's okay, because you already got paid. But if you were too aggressive with trailing your stop loss, you got taken out here and you missed the whole final move, the whole daily expansion. So most of my profits were taken here, and then June lows were my final target. So here's the EU market maker buy model trade of Thursday breakdown. I took this trade from my phone, so it was a bit chumpy, so to say, but I got the job done. The first thing that I did was I took my Fibonacci tool and I noted where we are in the current dealing range. So I took a Fibonacci from this low to this high and I drew the dealing range. Once the market traded into this candle's high and equilibrium, I went into the lower time frames to see if I was able to spot the market maker buy model. Why? Well, the previous week low had already been taken out here. So PO3 wise, we expect this to be the low of the week, and now we expect the market to expand higher and close up here in this region somewhere. So this was the low of the week in my opinion. Why? Previous week low has been taken out, market structure shift has occurred within here, so now we know, okay, the higher time frame institutional order flow is likely to be bullish for this week. And the Dixie also traded into a quarterly fair value gap. Lower time frame, I saw that the market traded into the high of that candle that I marked out, which is also the equilibrium of the higher time frame dealing range. I saw that the market traded into that during the London kill zone, so time and price meet. I saw a clear market maker buy model occur. I saw an SFT get formed with the Dixie because Euro made a higher low here, while Dixie also made a higher high, which is in correlation. Because if Euro makes a higher low, Dixie should make a lower high. But that wasn't the case. So that signaled to me, okay, smart money is actively accumulating long positions on EU. And because we had these highs up here, it was a clear buy in this fair value gap here. We had a market structure shift in here on the lower time frames. Do not look at this as a rebalance of a fair value gap, this move, but look at this as just a market structure shift that already occurred here. That's why this fair value gap holds price, and then the market expands higher into that 4-hour bearish order book, and also eventually taking out the previous day high. I took most of my partials around these highs and this 4-hour bearish order book, and I let a small part of the position run to new daily highs. So that sums up this video. I hope you enjoyed it. I hope you found it valuable. If you did, please leave a like and or a nice comment. I would highly appreciate that. I wish you all a great weekend. Rest and be safe. I'll talk to you guys soon. See ya.